Manjal University, Gurugram, your host for the day. I welcome you all to the masterclass series presented by Propel Pitch Fest 23. Propel Pitch Fest 23 is a platform provided by Atal Community Innovation Center at BML Manjal University and Propel Incubator to encourage new ideas, innovations, and young startups. It allows startups to interact with successful entrepreneurs, investors, and other ecosystem players. The investment pool for this year's event is 1 million USD. For the participating startups, so we just can't wait to get started. I am pleased to announce that our first masterclass is focused on funding choices and instruments. To kick off this event, we would like to begin with the proceeding of Propel Pitch Fest 23 Masterclass Series with the address by the VP of Growth at Capita, Mr. Srikanth Prabhu Sir. Srikanth Sir is a seasoned investment professional and venture capitalist in the startup ecosystem. With over 12 years of experience, currently, he is a part of leadership team at Capita as Vice President of Growth and Partnerships. Mr. Srikanth Sir has joined Social Alpha by Tata Trust to incubate and growth impactful enterprises. By the end of his 5-year tenure, Mr. Srikanth Sir had led 40 seed investments into fully fledged startups, now a veteran investing with 12 years worth of experience. When not interacting with startups, Mr. Srikanth Sir enjoys experimenting with various musical instruments, hoping to perfect his craft someday. But for today, he is going to help you perfect your craft as a startup with the help of this masterclass. Mr. Srikanth Sir, the stage is set and is all yours now. Please provide light to his domain with your thoughts.
Thank you. Thanks, Karima, for that lovely introduction. And thanks, Davinder ji and everyone at Propel Accelerator and this Pitch Fest. So glad to be providing the coming for the first masterclass. And we hope that, as you go through this journey, then you will be better prepared to put yourselves in front of investors. And I hope many of you look to raise a good amount of funding for your business as the need, as per your requirements, right? So given this is, I think, the first masterclass, the focus will be on actually going to a little bit of basics, right? Why are you even looking to raise capital, right? What are your different choices, right? So we'll start with that. I think we have another session planned where we'll be talking more on equity funding and more on shareholding, some of the nuances that you as founders need to be aware of before you go and raise capital, right? Because obviously raising capital has a very sense of achievement, right, in the ecosystem. But you also need to be aware as founders that it also means you're giving away something, right? And what is that? Because there are no free lunches, as they say, right? So you as founders need to be really aware of what are you giving away. Are you giving away ownership? Are you giving away control? A lot of those elements also come into a lot of those aspects also come into perspective. So my perhaps job over the next 2 sessions will be to, one, introduce you to the whole world of capital. We'll be discussing sources of capital today, right? Because again, whenever a startup founder says capital, the first thing they jump towards is equity funding. Ki VC ko pitch karna hai, let's get that done. We'll be in news and all of that. But did you know that most enterprises in this country don't raise capital through equity? They raise capital through various other sources. So as much as equity funding is what is getting the limelight, a lot of entrepreneurs choose to look at other sources of capital as well, right? So what we need to do today is actually, understand these different sources of capital and really understand for what different applications, which capital source is perhaps the most optimal choice. And that decisioning also depends on the stage of your company, right? When you're early stage, other people also look at your company in a different way. When you grow, people will have a very different perspective about your company. The trust and, the ability, their perception of your ability to return back their capital with the required return is very different, right? So as you grow, obviously different sources of capital open up. So as a founder, what are the choices you have is where you need to focus on, you need to think about, right? And exercise those choices or options available as you scale and grow your business, right? So that is what we will kind of focus on today. Um, Very briefly, I think thanks for that introduction. So I'm assuming, and I'm seeing that people are trickling in. So I'm assuming a lot of, perhaps most of you who have joined are running your own ventures, right? You must be founders of your ventures. What would really help? So what I'll do is I'll quickly share my screen so that I can, get started with the with the slides. Slides is just to kind of guide the discussion. I would love to keep the session more interactive. So let me first share my screen. Yeah. So I hope you are able to see my screen. Um, yeah, I'm from Capita, as Shivani, as Garima mentioned. I had growth at Capita. I come from investment background. Before this, been in the finance domain for the last 12 years. So would kind of bring that experience in this discussion. I would love to keep this engaging. So would at various points in time ask us some questions and hope that you will use the chat room to a greater use, right? So that we keep it engaging. We can also figure out a way in which you guys can speak as well if we need to make it more engaging, right? I think my introductions are given already. What I'll do is I'll share my coordinates. So if anyone wish to connect with me, you can connect with me either on LinkedIn or Twitter or email also. I can share later on. So it's already here. So you can always connect with me now or even later, right? Maybe what I'll do, and we will go into the basics. Before I go into the basics, what I would really help is, if I know 49 of you are here. So if you're a founder of a company, it would really help for me to know who all are in the room, and we definitely can't get 49 people to talk. So let's use the chat room. So if you can just drop one line about how would you describe your company, right? And maybe one question that you have about the topic, right? Funding instruments, funding choices, various sources of capital, and so on and so forth. So if you have any question, you can include that, but it will just help break the ice. I will also know who all are in the room. And you can also say, have you raised funding in the past or not? So if you can just mention this all in 1 or 2 lines, that would be great. So I request someone to make a start. It can be as simple as, I am founder of so and so. It runs this one-liner, and then I'm looking forward to hearing about this, right? Something like this. If you can just type, that will be great. It will help me guide the discussion better. It will help me keep it engaging, and maybe you can participate as well as we kind of go along. Okay. So just a request. I see that no one is making a start, but I know some of you might be typing. So I see Avamsi has made a start. So Avamsi is into medtech. That's wonderful. I'm assuming many of you are early stage. I'm assuming you might not have raised an equity round funding. You can also include that. You might have some questions around that, so you can mention that. So we'll cover these elements today. Like, what are the why do you need capital? That is the first thing, right? Sometimes it's always assumed, okay, business start ho raha hai, so I have to raise money, right? But why do you really need it? Where should you deploy it? And for the various reasons you need it, what are the optimal choices? That is something we will kind of cover today. It's great to, so Vamsi wants more information on alternate source. Very good, Vamsi. So we'll cover that today. Tushar is doing something in automotive electronics. That's wonderful. Equity-based financing, strategic investments. That's great. I think you are already looking at plethora of opportunities. We have Kirti, who's doing something in the juice, cane agriculture or food related. Yeah, great. Good to see I'm seeing them. So do keep them coming. I might not read out everyone, but I see a diversity of startups who have joined here. So that's wonderful to note, right? So as you answered, as you talk about your company, here is a question, right? Why does a business need capital? Now, can I get 1 or 2 word answers for this? Why does a business need capital? I'm sure all of you are here in PitchFest to eventually raise capital, right? Why are you raising capital? Scale, okay. Isn't that a broad thing? Of course, everyone wants to scale, but what does scale mean? That would be good to know. So, but great scale is just right for survival. Of course, Nishan, survival to matlab is needed, right? And some of you would want to survive by raising capital first. Many others, most traditional businesses survive by making profits, right? So that's also a source of capital. We'll talk about that. It is one of the basic resource, right? I would actually try to counter that argument, right? Maybe capital might shouldn't be your basic resource, right? As a business, your basic source of sustainability survival should eventually be customers' money, right? But you obviously need that initial catalyst. So we'll come about that. Growth, I think scale ka alag thoda alag meaning is growth. I mean, so that's good to go to the market faster. That's very wonderful, Tushar. Maybe I'll come back to you. That's quite nuanced as well in itself, right? Of course, there are various ways in you can grow your business, right? A lot of businesses before the last 15 years, 10 years have grown businesses by not raising equity capital, right? They have just grown. They might have taken some loan, but they have grown, right? They might have not grown 3x, 4x in a year, but they would have definitely grown in certain percentages and they have lived for decades, right? But you have seen the last 10 years as the startups want to grow faster, right? So that's a great thing that Tushar mentioned. So we'll double click on that. Great. So I think wonderful. Thanks for that engagement, right? So what I have done is I've distilled this simple question into a few buckets, right? Because all that you mentioned kind of can distill into few things, right? So this is my way of looking at it, right? One is initial seed capital, right? Now this is where exactly somebody mentioned survival. Nishant mentioned survival. Of course, you should be worried about survival in the initial phase, right? Because it's not that you're opening a business today and you start making revenue tomorrow. Maybe there are some lucky businesses where that can happen, like a consulting business or a services business, where maybe you can start your business with customers in hand. But especially when you're building a product, you are coding, you are manufacturing something, obviously that requires some seed capital. To what extent do you need capital? Again, depends on sector to sector, right? In a segment where the market is already established, the customers are waiting, you can start making revenue, but that initial fixed cost, getting the working capital, it might need some money, right? So that's where you need to get the business going. You need to hire the team, right? The team will not come and join you just because they know you, right? They also want some uh, compensation and those elements. Of course, there might be some people who trust, who are your early champions. They will join you without maybe salary also, maybe for 2 3 4 months, 6 months. But uske baad you will have to start paying them, right? And then also it will take some time. You might have to hire softwares, I mean rent software subscriptions, this and that. So a lot of cost is needed to just get the business going itself, right? So that, let's bucket that into the initial seed capital, or what the capital that you need to even get your business going, right? Without this, you can't even start. Many founders try to source this capital within their own ecosystem. A lot of seasoned professionals will say, hey, why should I dilute, matlab, why should I give away ownership right away? I really believe in my own idea, so I have enough savings, so let me put some amount of my savings to get this business going, because if I go to the market with something already there, I might attract a better valuation, I might attract a larger capital, and so on and so forth. So many founders might choose to use their own sources of capital, like their own savings. Their family might put in some money, their friends might put in some money. So that is what is called as bootstrapping, or initial friends and family, right? You can either bootstrap your business, or you can kind of get your friends and family to kind of trust you, because when you are getting started, there is no business plan, all of them are on paper, right? Nothing has been established. So it takes a different level of trust for people to really put money into your business. So that's where mostly bootstrap or friends and family and those things come in, right? As you grow, right, some business models with that initial seed capital, like most shops in India, right? कोई भी आप दुकान ले लो, right? You need that initial cost for capex and this. Sometimes banks might give you the loan, but let's say banks भी नहीं देते हैं. So your own family, your savings with that you put in, and then you start generating profits within 3 months, 6 months. You start recovering, you start becoming monthly profitable, and then eventually you recover everything, right? And now that's the ideal world for a small business, right? But especially now you're thinking of growing faster, which is what I think Tushar mentioned. You will be competing with other startups, other companies in the market, right? And they are also aspiring to grow faster, right? And eventually capital becomes one that catalyst, right? I would say it is not really an existential need. The business can survive perhaps because it's unit economics, making profits and all of that. But you will be competing with others in the market, and there is a tendency, or there is a little bit of a pressure sometimes as well from your investors, from other stakeholders, to grow faster, to become a market leader, right? And things like that. So there, you might use capital as a catalyst, saying, let me put more capital, usse market share I can acquire, and then once I get a larger market share, I can consolidate. Just like you see, right? We all started using Swiggy, Uber, and all of yes, Nishant, will come to you. Unfortunately, not a lot of things I mentioned will work for many of you, but that's my idea, is to give you the plethora of options. Then you can see what will work for you, right? But I was coming to, like, when we were using Swiggy, Ola 5 years back, all kinds of cash discounts, cash bags, this was existing. And now you see, for every Swiggy order, you'll have to pay like 20 rupees, 30 rupees as delivery charge, right? So as you see, people, when companies consolidate their market share, they might then start aiming for profitability. But until then, they actually burnt money, right? To acquire customers, to change our way we, commute, or the way we, eat our food, right? By ordering, right? It's a fingertip, right? And now it's irreversible. Like actually what Kunal Shah says as Delta 4 change in behavior, right? Now we'll never go back, right? So now they can consolidate and making money, because business is all about making money at the end of the day, right? So you can see that until that growth and expansion phase, you can still use capital as a catalyst and start growing fast. That's what Tushar mentioned, right? And there also you can deploy a lot of sources of capital, which means that you might not be profitable for some time. That's a very conscious choice that you are taking as a founder, and many times investors are also willing to back you. In fact, that's the reason why you'll be needing more and more capital, because the moment you turn profitable and you're growing at a healthy pace, then you actually don't need capital from there on, right? But you need growth capital, because in that critical phase of growth, until you, let's say, become $100 million company, or I mean whatever that benchmark is. I'm not kind of dictating that 100 million is success. There are companies which have billions of dollars revenue, and there are very successful small businesses that have a few crores of revenue, right? So there's no right and wrong here. But you yourself will have a benchmark of your own company. This is success for me, or this is where I feel I need to achieve in these time frames. And you might have to, you might have to look at capital as a catalyst in that journey, basically, right? And then once your company becomes established, right, this is where large companies, you see, like listed companies in the stock market, of CNBC dekhte ho, right? Whatever you see, right, online, you'll see, okay, I'm raising so much money in IPO, or as a public offering for capital expenditure, right? Or I'm raising this money in bond market for capital. So capital expenditure eventually comes. This is typically spoken in the parlance of large companies who are looking to establish factories, or a lot of fixed assets, where you plant equipment, machinery, because they have the ability to provide future cash flows for that business, like a steel plant building the next steel plant in some of one geography, right? And then as the business continues, it still requires capital, right? Because a lot of businesses, the way it works is the revenue comes later, right? You still have to deliver value to the customer, and the revenue comes later, right? So this difference between when the revenue comes and when you actually need to put the money into the business, there's a delta, right? There's a period. Until then, there's some risk involved, right? Because you're putting the money into the business to hopefully create the value. Eventually, the customer gets the value, and then he or the company basically pays the revenue, right? So this difference is basically the working capital, right? Where you need to put money into the business to eventually recover the money as revenue, right? Which can be raw material costs, it could be some of the service provider costs, a lot of operating costs that you're involved, right? So this is business as usual capital. This is some strategic decisions you make to expand your business. So basically, all of these require capital, right? To answer your question, right? I hope this broadly covers a lot of things. If you have any alternative viewpoints, do share on the chat, so we can make a discussion out of it, right? But broadly, most of the startups we hear, most of you would be falling into these two categories. This kind of nicely summarizes why you need capital. Of course, some of what you need here is also capex or working capital, right? But the business is so early that everything you need capital to kind of kind of put into the business, right? While at later you can actually demarcate. Okay, for capex, okay, I will go to the equity markets, or working capital, I go to a bank for debt, right? In early stage, most of you unfortunately will not have that many choices of capital. Just like for Nishant, and unfortunately, friends and family has not worked, right? So very few choices are available for you. So you'll have to make the optimal use, and we'll come to those elements as well. Okay. So I hope so far so good, right? And good to know that a lot of you are building very diverse businesses. Some of you have not introduced, do that. I mean, it's not late. It also helps others in this webinar to see what you are building, and maybe some connecting the dots can happen. So my urge to founders is wherever you get an opportunity to showcase, you just do it. It always helps. Who knows, one customer you might earn, from this webinar itself. Okay, so now that we've decided why you need capital, right? Now let's come to what are the different sources of capital. Here also let's keep doing this a little bit of a quizzing at every stage. So why don't you put in one word responses as to what are the different sources of capital very quickly. So one word, two word responses. So what are the different sources of capital? Any quick responses? Fastest fingers first. Incubator. Okay, Nishant, good one. Vamsi says debt. Wonderful. Accelerator, incubator. These are very nice terms you are hearing these days. 10 years back, Nishant, incubator had a very different meaning, but now it's very different. It also goes to suggest the changes we are seeing rapidly in the ecosystem. Contribution labs, I don't know the name of the person, but government grant, very smart. Not many people look at that as a source of capital, but especially startups of your stage, you definitely have to look at it. It's grant, as the word indicates, is non-dilutive. So agar koi free mein paisa de raha hai, to you should take it, right, and use it, right? So that's good. Central government crowdfunding, very good, Abhijit. Although I'll advise a little bit of a caution here. A lot of crowdfunding platforms are under the radar. You must have heard some news and all of that. So ensure that you are complying with the regulations if you are going for crowdfunding. Nothing wrong with those platforms, but just understand the risks involved as well, if any, right, based on the instruments they use, right? So great, micro VCs, as Nishant says, that's a kind of a VC. So we'll get to it. Mohit goes to the ultimate reality, IPO, right? Everyone desires to eventually go public and get that moment of fame in some sense, fame or success, as you can say. Angel investor, I think you guys are well trained, or you already know a lot of things. Vamsi, again, he also mentioned debt. Now he goes nuanced. Invoice discounting. That's wonderful, Vamsi. Invoice discounting. Competitions. Again, Nishant, this is something at this stage of the company, these are all great sources. And these are very easy sources if at all you get lucky. So why don't, you should do it. So I'll come to it. Mohit Gupta takes bonds. I think, again, Mohit is more dealing with public markets a lot. So initially he said IPO, now he said bonds. Again, great source of capital. Most of you might not be able to raise bonds at this stage, but yes, once you grow bigger, that's a very, very cost-effective debt source, right? Because you're democratizing debt to lot of thousands of bondholders in some sense. So maybe that's a more optimal source of capital than going to a bank who might charge you, several. Yes, I know, like many of these might not work, but good to know those things. So what I have done, thanks for all those inputs. I think that's what makes this more engaging. So thanks for doing that. So I've tried to again distill many of what you said into things. I think everything that you have said does figure into one way or the other. I have not taken public market sources here because many of you will not be considering going public maybe in the near future, right? You might not be on this webinar if you are closer to your IPO in some sense, right? So very, I think some of them we have already covered, right? Bootstrapped, we said self-funded, friends and family, right? Profits, again, in this age of venture capital and funding and Shark Tank, many people might lose focus ki yaar, profit is the ultimate holy grail. Matlab, your business will only survive only because of profits. In fact, all the other sources of capital will only give you money when they see this, when they foresee this, right? In the sense, only when it's there in your future business plan is where others will even trust you to. Of course, friends, families, and fools, as they call it, they might trust you even without that because they trust you as a person, not maybe as a business model. But all the other sources of capital, they are putting in money because they are hoping that ultimately profits is what will pay out for everyone, including you as founders, right? So don't lose focus on this. It's my one takeaway. If at all you only can take away one thing, but there are many other sources you can look at. So there are a whole host of debt sources, which can be like short-term debt, which can be long-term debt, which can be venture debt. The venture debt is also something that has come recently where it can be like a simple debt, or it can also be a little bit of a hybrid of equity and debt. But they might still, you are still supposed to repay the instrument, but they might take some equity risk also in your company, or they might take an optional equity like warrants or something. I'll not cover much of that. Actually, I'll cover that towards the end. And Vamsi, CCPS, CCDS are more instruments. I'll come to that. That's the next part of the discussion. And then, of course, these are all the different debt sources. Then there are a lot of equity sources. Now, equity, many of you mentioned a few things like angels, high net worth individuals, family offices. I can also add micro VCs here, right? Angel platforms are there who put in the first level of risk. As the name indicates, they are true angels to you in some sense because they are willing to bet on you when no institution is, in some sense, right? Then there's a whole host of micro VCs in between and venture capital later. And like whole host of angel platforms, there are many, right? There's Indian Angel, the Mumbai Angel, Chennai, like a lot of cities have their own angel platforms. There are some central angel platforms as well, IPV, or I saw someone Jito here, like Jane Angel Network, so things like that. So there are many angel platforms as well. There are some micro VCs. Some of the micro VCs I can name are like Gemba Capital, Java Capital. These are all typically 42 VC, early ventures. So these are all like early stage VC who to put money in pre-seed and seed. Then there are a whole host of venture capital who put money across the stack, start with the pre-seed and seed, and then go to, these are the terms you would have seen, Series A, Series B, and so on and so forth. The famous ones are the likes of Sequoia, Matrix, Prime Ventures, or Bloom Ventures, so on and so forth. Again, there are dozens of these investors. I can share a wider list if you reach out to me with a list of companies, and many of them might be attending your pitch as well. I'm sure. I think there are a lot of investment partners that AIC BMU has put together as for this pitch fest. And then there's private equity. The private equity comes later in the journey of these companies. They are the ones who put a lot of money, right? They come like at Series B, Series C stages, and then they also take a lot of stake. So you have to be very careful with private equity. If you aspire to eventually be acquired or go to IPO, etc., private equity could be a good play, right? And they also very focused. There are health private equity, there are education private equity, etc., where they go fintech private equity. They go very deep into the sectors. They have expertise as well, and many times they might also play an operating role. You might have heard of cases where founders start the company, but ultimately once the company grows, then the founder might also exit. That has happened in multiple cases. Very famous ones are like Flipkart or BharatPe and things like that, right? Where and many times it can either be investor backed decision or private equity backed decision to change the operating, or maybe the founder also wants to exit. So there's an amicable thing. Sometimes it's not amicable, but private equity is also they typically, when you hear private equity, you sense that there is a larger stake, or they will eventually take a majority position in such companies and then either sell the company to someone or get into an IPO so that they get their exit, right? But they are more strategic, right, than a venture capital. Venture capital will manage, like a 5-year, 6-year venture capital portfolio might range in 30, 40, 100 companies. All right, but a private equity typically, will have not a lot of companies as venture capital, because they will also look at smaller size but more deeper and larger stake in those companies. And ultimately, finally, the journey after this is the public markets, right? Once you have raised money with venture capital, private equity, then the logical next step is to go IPO. Many companies might choose not to go IPO until a certain level. You are also seeing that many startups who went IPO last year, in a way have taken a beating in their stock prices. That's also because public at large, might not digest the kind of business models the startups have been doing. That also is changing in some sense. So there's always a sense of early profitability that investors and public markets wish to see, and hence they will discount the prices if they don't see clear pathway to profitability. So you can see that a lot of companies that listed were not making profits as soon as there was tightening in the macroeconomic situation. You can see their stock prices actually corrected a lot, right? So that's why a lot of founders nowadays are cautious. Many of them wanted to go IPO, but they have delayed their IPO for 12 months, 18 months, and so on and so forth. As you can see, last 12 months, no startup actually has gone IPO, right? So founders are cautious of those elements as well. But just for completeness, I thought I'll cover the whole host of options that you have, before you kind of go along. Okay, so this gives you a full picture, and many of the examples that you mentioned, right? Like somebody mentioned angel platform, somebody mentioned micro VCs, which comes in between. Many have mentioned a few debt that comes here, right? Vamsi mentioned CCPS, CCD. They are just instruments. So all of these equity sources can be raised through a CCPS or a CCD. CCD is like a hybrid instrument. So there are share-based instruments, there are debt instruments, and there are convertible instruments. We'll kind of cover that in the instruments in the next phase. Right? Next slide. Okay. As a small company, should we consider to private equity? No, not really, Abhijit. Matlab, if you're a small scale company, private equity will by default or by design will not be interested in you at this stage. You might have to be a little bigger, acquire a lot of customers, revenue, and like you should stand out in that ecosystem, in that market. Private equity will definitely be interested in that sense. Having said that, there have been exceptions. There are large late stage VCs or PEs like Tiger Global who have also invested in a Series A stage as well in India, but those are very exceptional cases. But generally, these large VCs with deep pockets or PEs, they come much later in the life cycle of a company. See, I don't have much idea on BSE, but I know that they have been doing rounds for a lot of years. But I haven't come across startups who have really leveraged the stock exchange at an early stage. Only once you arrive at that definition of a small cap or a mid cap, like typically like you have 100 crore revenue, that those are the times when you can you would like to list. And because another thing as founders you need to really understand is the moment you list, you are subject to a lot of diligence, regulation, transparency, disclosures. You have to file your quarterly earnings. Those are things you don't need to publicly file now, right? So you also need to take a conscious call when should you go public and really put yourselves out there and go for quarter on quarter. As I told, a lot of startups did that, but they also weren't able to justify their listing price, and they had to come down. So you have to be very careful with that, right? I'll take some of the specific questions later, right? You can also privately message me or connect with me like on LinkedIn. Okay. Great. So I think we are on track. Let's continue. So this slide I had prepared a few years back actually, but I thought I still find relevance to show it. So that's why I'm showing it. So a lot of the examples you see, these were keeping an impact sector in mind, but you can replace these perhaps, right? So this is the typical journey of a lot of you, right? You start with the lab to prototype, or you start with an idea stage, then you go to the MVP stage. Then you go to the go-to-market. When you are beyond MVP, you have tested your product. Now you want to grow and go to the market, and then you eventually want to grow and scale, right? So you can see there are different sources of capital, different sources. And then I have also highlighted, and this kind of relates with a lot of the examples or lot of inputs that you all gave, right? So you can see I have actually added grants everywhere, right? Because early stage, you should have cognizance of where are the grant opportunities. Thanks to our government programs, thanks to a lot of incubators, accelerators, thanks to a lot of philanthropic organizations, they all want to promote innovation and entrepreneurship. So if you're building something innovative, you're solving a societal problem, you're solving any problem to that matter, there are sources that you can tap into, right? So it's important for you to understand what those grant sources are. Like now, for a simple example, did you know that Department of Biotechnology has a BIRAC program for entrepreneur in residence, right? There's a Nidhi EIR program, which gives basic monthly sustenance to a lot of founders to even just start a venture, right? And again, through the incubators, right? So as even at an idea stage, you as a founder maybe can get a 50,000 or a 1 lakh, I don't know the details, as a grant to just run your business, right? Did you know that at an MVP stage, Government of Maharashtra gives a 15 lakh grant as for market access, right? To test your model. And it can also be at a market GTM stage, right? Did you know that Government of Karnataka gives like almost 50 lakhs? I think the number has come down, or 10 lakh to 50 lakhs of just grants to a lot of early stage startups, right? So if you see, and the Government of Tamil Nadu also has started something. So based on where you are, a lot of the government programs plus a lot of accelerator programs, etc., gives either grant in cash or in kind. So as early stage startups, you should definitely know about it. I have created some database of this various sources. I can share that, if you reach out, and you should keep an eye on the calendar, like when, what sources. So I would generally advise early stage founders, keep an intern, who just keeps an eye on this and keeps applying. Generally, all these applications, they have the same question, right? What is the problem? What is your solution? How big is the market? What is your traction? So if you have those questions ready and handy, sorry, then you can keep applying. And if you get lucky, just 10 lakh here, 15 lakh there, it just helps you run your business for that critical initial phase, with which you can then raise a larger round of funding from investors. So don't lose sight on this. However, don't put all the eggs in that basket also, right? Don't rely on that to take your business ahead, right? If you can see equity, I put everywhere because equity is also the most riskiest form of capital, right? Um, so I'll talk about micro VCs. So if equity is also the riskiest form of capital in the sense that they are willing to bet on you when no one else is, right? No bank will give you money, right? No bond market will give you, no public market will give you money. That's where equity investors will give you money, right? With different classes. That's because you are also giving away something very, very valuable, right? That's a risky asset, but you're also giving away your ownership, right? And in debt and other markets, it's just whatever you're taken, you're supposed to repay it with interest, right? But in equity, you are giving away your ownership, right? And this again is not something that founders understand very intuitively early on. Is your equity is the most expensive form of capital. Equity is the most expensive asset that you have, right? And hence you have to give it very, very carefully, right? Just a simple example is, let's say if somebody gave you 50 lakhs and you gave them 10%, let's say your company becomes a unicorn tomorrow, then that person is getting 100 million worth value, right? So in the event of your company becomes successful, there's an outsized returns that an equity owner can make. And that is also the model with which these investors invest in you, right? Because they also know most of their portfolio might not make them outsized returns, but a few will. So let me take significant stake in these companies so that whoever wins, I win with them, right? And it can kind of underwrite the risk of all other investments which might not have made them money, right? So equity works like that. So, and you as founders also need to be very careful in giving equity. So my simple point is, if at all there's a possibility of getting some money as grants, then you don't need to dilute all that money to get equity and dilute a lot of stake, right? Conserving even 5%, 7% early on, you can raise a lot of capital with this for the same stake later on, right? So be conservant with your equity is my initial kind of point here, right? And you can like bootstrap it. You can get your incubators and angels. You can go to micro VCs, which I'll talk about, right? And you can go to debt. So some of the micro VCs, I think I would have mentioned. Some of them are here. So coming to micro VCs, as Tushar asked, again, there's no, to be honest, there is no standard definition of a micro VC. For example, a Sequoia also kind of acts as a micro VC because they invest in their Sequoia Sprout program and Sequoia Surge program, which are early stage investing. Like they invest up to $2 million, right? Typically, micro VCs invest plus or minus $1 million kind of thing, 500K, 200K to like 1 million, 1.5, 2 million also, right? So in that case, Bloom also acts like as a micro VC, but they also have put in larger checks later on, right? So in a way, they operate in both the areas. But there are some pure micro VCs, like somebody like Gemba, I said, they've invested in good companies like Airmeet and Verak, which got acquired yesterday, and Plum Insurance, and so on and so forth. So they act as a micro VC. So the way I define them is they typically invest somewhere between 200K, which is about a little over a crore, to maybe 2 million maximum on the other end, right? And they typically invest in pre-seed and seed rounds. Antler is like a micro VC, right? They invest in like I think $250,000 or $275,000, right? So they are like a micro VC, right? And yes, the micro VCs could be the first VCs you can go to. You can also go to a lot of platforms because they also invest anywhere between a 1 crore to any size that you are aspiring for, right? There are a lot of incubators also, like they would be very much interested. And the earlier you go in the journey, the earlier they are able to take risk, right? So like a AIC, BMU might have a Nidhi, like a seed fund program. So they might invest in companies which, let's say, VCs might not touch right now. But that's the mandate of an incubator, that they want to support a lot of early stage companies, and a few of them will actually end up raising a larger capital and then grow from there, right? So that's the way VCs work, right? So that's quickly. I know some of you have put very long thing. I'll read them later, right? I'll also. I mean, so my company is Capita. Just a pun, basically, right? So Capital is like C with C only. Capita is my company, so just so seeking in that sense, yeah. And you can see that here I have also mentioned why should you use the sources. See, grants, equity, debt. I'll cover this in a subsequent slides. Okay. And these are indicative names. Don't go by these names. If you want a more comprehensive list, please write to me, and I can share you a database of maybe 100+ investors, whom you might tap into, and based on their sector. So now what I'll do is I'll actually cover the various sources of capital in a little more detail so that you are taking that away very concretely. Okay. So like I said, many of you, the moment you start to think of capital, you think of equity, you think of debt, you think of bond, everything, but you stop thinking of revenue, right? But that is the most important thing. That is the holy grail. This is why everyone is rallying behind you for this reality, right? कि आप लोग पैसा बनाओगे, right? And only when you make money is when everyone else makes money, right? Even a debt holder makes money of the revenue, right? If the company were not generating revenue, then unfortunately no one gets to party in some sense, right? So so that's why financing through customer revenue is important, right? That's why you see very cash surplus businesses like TCS, Infosys, they all are sitting on Apple, right? They are sticking on stockpile of cash, right? And that all that cash is from revenue, right? And they're also returning cash to the investors through dividends, right, in the public markets, right? So you also maybe need to aspire to get to that situation where you are cash surplus in some sense, right? And then you can grow from that business, that cash surplus itself. You don't need to rely on an external source of financing. But in that growth stage, early stages, you are forced to rely on the external sources because you need that catalyst. You need good people, you need good product, you also need capital to grow, right? So why financing is important? First thing is customer revenue doesn't come with any dilution or liability, right? You don't have to give away your stake to someone. There's no liability for you to repay that money to a bank or a debt holder or a bond holder, right? So it's amazing money, right? Like it's there with you on your books and you can use it for anything you want as the company decides, right? Second, very important as for all of you early stage, right? It validates your business model. When some customer is putting in money, right? They're putting their money where mouth is in some sense that, it validates your business model and your economics, right? People are giving money for you. That means you are generating value for them, right? So your value proposition gets established. The customer is making value and hence they are giving some portion of that value to you as revenue, right? It's a great place to be in. Many of you might already be in that place. So you need to really double down on what can expand that. How can I make margins better or how can I expand my reach better, right? That's what is the third one. Earned in exchange of the value you create for your customer. That's a great place to be. Many companies might have raised a lot of venture capital funding, but not have created value to their customers yet. And this is what a lot of jargon in the VC world is called product market fit. That you might not have product market fit. That means you raise a lot of money on the back of a hypothesis that you will create value, but you ultimately didn't create value and you're not able to make a lot of revenue, right? So that I will be very worried as a founder, if I am in that situation, right? So hence any validation that you're able to create value by creating value for the customer, for yourself, that's great, right? That's where the customer revenue comes in, right? And ultimately, what is the thing, right? Sustaining through revenue is the ultimate end game. See? Everyone is aspiring for that end game. Angel investor who put money 2 years before also wants ki aap log sustain your revenue through revenue because they know they will make their exit only when that happens, right? Or when you're going in towards that direction, right? And that's where you can go to IPO. A lot of opportunities exist, right? So everyone is working, including you, right? Your eventual value as founders will get created once you are able to sustain your business model through revenue, right? So hence this is the best source of capital. Sometimes underlooked, I would say, but you should always keep reminding your organization, everyone, even including your technology people, coders, developers, that they also need to know whom are they building for, are they creating value, that culture and that things should be percolating down as well to everyone, right? And hence one small nudge here is always gravitate towards value-based revenue. बहुत बार, India में whatever we are building, we try to be cost conscious, right? And we also then revenue maybe we are defensive कि चलो cost plus margin कर लेते हैं, right? We'll sustain. But you should have a value mindset, right? See, Apple has a value mindset, right? Hence you as for maybe that same device, which might have cost Apple 10,000 rupees, you are paying 1 lakh because they are going for a value mindset, because mine and your perception of an Apple product is more than 1 lakh rupees. I'm willing to pay 1 lakh. Or they might also have given us that perception by building very cool products and being the cutting edge innovator, right? So you also need to think of that value-based mindset. How do I maximize my value by giving a higher perception of the value? So your thought will not be into optimizing cost, but maximizing value for your customer or perceived value by the customer so that you can extract a lot of value, right? And the more value you create, you are a high gross margin business, which means everything adds up, right? you can raise large amount of capital, your valuation goes for a high and all of that, right? And yeah, all kinds of revenue, your sale, commission, brokerage, subscription, referral, everything is like a revenue, a kind of different kind of revenue. Okay, so this is the customer revenue. I know we are kind of running here. So next is the equity, right? This is the most common form of startup growth capital. In 2021, I would say this is it's raining everywhere. Like you go with an idea and you would have raised money in 2021, but since 2022 and now 2023, it's a funding winter, right? But still, it is the most common form of startup growth capital. If you are running a fast growing business, you want to grow fast and build a market leading business, then many of you would be approaching angel investors. In fact, most of you are applied to Propel Pitch for the same reason, that you want to raise equity capital. Rightfully so, because this is the capital available to you at the early stage when it's the most risky, right? So here you have multiple sources. There's common equity, which is the common shares, right? This is the shares you trade in the stock market, equity shares. But most investors will ask you for preference shares because they also ask for a certain preference. So somebody mentioned CCP. I think Vamsi mentioned CCPS. CCPS is like a compulsory convertible preference share, right? So preference shares comes with a certain rights. Again, we'll not cover too much here. I think next session we can cover a little bit on preference shares, but they are the share-based instruments, right? Then there are also instruments like warrants, like typically lenders and debt owners have, where they have a warrant to convert some of their value to equity if you're not able to repay them, kind of a thing. There's an option they keep, right? Then there are a lot of equity linked instruments or pseudo debt instrument. Again, Vamsi mentioned CCDs. So like these are all convertible instruments or safe notes. Y Combinator usually raise safe notes, CCDs, OCDs. So these are like they act as debt on day one. In fact, on the books of your company, they are treated as a debt, right? But they convert to equity later, right? On certain event, like you raise the next round of funding. This also is a kind of a smart instrument early on, because many a time you start debating on the valuation when there is no real basis, right? You have not made revenue. This all an idea basis. The valuation can be anywhere, right? So you say, let's postpone the discussion on valuation and let's just take the money in and let's build the business. And subject to the next round of company's valuation, we can benchmark the valuation and take a discount, right? So that's why you have convertible notes, safe notes, CCDs, OCDs. A lot of incubators put money through the debenture route, right? So that's the equity linked instrument, right? And like I said, equity is the most expensive form of capital. They're giving their valuable shareholding. So be very careful. Don't abuse it. You have to retain your skin in the game. I just spoke to a founder yesterday who said, my future investors are very cautious because I have given away most of our company to investors, right? So you should be very, very careful, because if you give away a lot of equity upfront, it signals a red flag for future investors, because they say, "Acha, ye founder ne pehle hi sara equity de diya hai, so how much is left for this person once we come in and they get diluted, right?" Because ultimately, if you don't have enough stake in the business, what is your motivation to run the business with that amount of passion, right? So that's why it is obviously very much important for you to dilute your equity. Only then you can raise money, but don't abuse this source, because let's say at a Series A stage, you are not even a majority shareholder in your company. Then investors will start thinking twice whether there is enough motivation to the founder to continue running the business. Maybe they'll just quit and maybe run something else altogether, right? So it's very important for you to retain your skin in the game, right? And I'll talk about that, Tushar. I'll actually talk about it now only, right? Use equity, but before that, I'll say, where should you use it hence, right? I'm bringing so much caution because all of you are going to raise equity sooner or later, right? But I'm bringing caution because sometimes there is a tendency to take more and more equity and dilute more and more, right? So thumb rule is use equity capital for the highest leverage items. I know early stage you might have to use equity for everything, including for working capital, including for including for your sales people's cost and all of that, right? But ultimately, you should once you get to a Series A, Series B stage, you should rationalize. Equity should go to the highest leverage items, which means it gives you outsized returns for the investment you make, right? So like product development. आज हमने product बनाया तो it can outlast you. It can give you revenue. Like Apple created iPhone in 2007, and already you can see that how much value it has created for them, right? So that equity investment would have given them outsized return, right? Like hiring leadership team, like hiring a Steve Jobs, that's wonderful, right? That person himself can give you so much value, right? Fixed assets in some cases, right? Operating costs should ideally be avoided over a period of time. I'm not suggesting that you should avoid operating costs. Of course, you should hire your marketing costs, sales costs, etc., all through equity in the beginning. But let's say the Series B stage, you should start thinking twice. Why should I fund this marketing campaign with equity money? I should ideally fund it through revenue. If that marketing campaign is not giving me revenue, why am I running it, right? So these questions should start coming in your head, right? And hence, I say this thumb rule you should always remember, right? And sources we have already discussed. Now coming to Tushar, again, no one right answer, and this is also a little bit of investors market and founders market. Maybe 2 years before, you would have raised a $5 million seed round at 20% dilution, but today nobody is giving you a 5 million seed round. So you should be happy with a 2 million seed round, let's say or a 2 million series A round at a 20% dilution. So my benchmark is early stage at a pre-seed, angel pre-seed, you should be looking at around 15% dilution. If there are incubators, accelerators, it can go down to 10%, right? And my benchmark is at least get 18 months of runway for that dilution, right? So have a 10-15% for the first round. Of course, if VCs come, they would demand more. I mean, because they also want a 15-20% initially, right? At a Series A, Series B stage, that number starts getting to the range of 20%, 25% also. If it's 30%, you should start thinking twice. Are they giving you that much of runway that 30% is justified? Those are the questions you need to start asking. Of course, because of the market correcting, your leverage or your bargaining power has gone down as founders. Investors have a higher say now because not a lot of deals are happening anyways in the later stage, right? So, but these are broad benchmarks you can go with, right? Early stage, keep it around 15%. Series A, Series B onwards, keep it around 20% plus or minus 5% in all these cases, right? So this is the kind of dilution. And every round, assume like a 18-month or a 24-month cash in the bank so that you can run your business without having to think a lot about it. See, yes, it is always said that one founder, it's like, it's a bad analogy, but venture capital is also like a drug. Na? Ek baar aap lete ho, you can't stop it. Okay? Because even the company, the person who gave you money earlier, he is not waiting for, he or she is not waiting for you to give you dividends later on and become profitable. They also want instant, matlab ki sab exit mere ko ek baar mein mil jaye, right? So they also want you to raise the next round and next round and next round, so that you get into that cycle. You can't avoid it, but that's the game everyone plays. It's of course your choice whether you want to play that game or not, right? Many people are not choosing to play that game and they're just becoming bootstrapped and successful, maybe raise bank funding or just raise from strategic friends and family or some angel and be happy with it, right? But many of them, once they get into the VC game, they unfortunately can't stop, right? So, and hence, you will have to dilute to the right extent so that be relevant and, eventually give exits as well, kind of a thing. Okay, so great. We are unfortunately neither, Nishant, we are a SaaS platform. So I will share about Capita very soon, where you can sign up on us and be funding ready. This is a offering we have for all the companies of this cohort as well. I'll cover a little bit of debt. Again, might not be relevant for all of you at this stage because you are early stage and all of that. That's why I'm telling elusive capital that everyone wants it, but only a few get it, right? Because no matter how much noise the government makes, the mudra banaya, I've not found a lot of startups who have easily got debt, right? You will need 5 years of balance sheet or at least 3 years of balance sheet, profitability, so on and so forth. मतलब तब तक उतना hard work कर लिया, then you might not even need debt, right? You might be profitable, but then that's the nature of the beast in some sense. But debt, a lot of later stage companies use it for a lot of a lot of options do come. So debt may aapka banks, financial markets. There are some incubators and some government schemes which give soft loan as well. So look out for that. If that option is there, just take it. Like somebody is giving you an 8-year 6% loan, that's wonderful, right? I mean, you should take it, right? Then there are all kinds of loans, secured, unsecured, guarantee. There are also some of these instruments like first clause default guarantee, where government or some government scheme can underwrite some of the risk and things like that. Then there is credit capital markets, bonds, NCD, securitization. These are again not very relevant for you at this stage, but academically just keep it in mind, right? But remember very much, right? Equity may, even if you go down, it's fine. It's fine to fail. In debt, it becomes difficult to fail in the sense that it's a double-edged sword. One should sport it, only one way can wield it. Debt, there is this concept of repaying, right? It's not that you're not repaying in equity, but in equity they have your shares and you're repaying for that ownership. In debt, there's a liability. Meaning you have to prepay it, right? If you are a business and going concern, you have to repay it. If you don't repay it, they can actually take you to the bankruptcy court and all that and completely liquidate you, right? Liquidate your assets and things like that. So you should be very careful in taking debt. A lot of companies, early stage startups, blindly take debt if they're available, and they realize that it becomes very difficult to repay, especially in an interest rate market like this where interest rates are going up, which means your EMIs will go up as well. As much as it is impacting your house loans, it will also impact your corporate loans as well. So you have to be very careful in taking some of these instruments. But my benchmark is raise debt only when you have the predictability to repay the cash. So if you are hiring a CTO, the answer is definitely no. You should not take debt to hire your CTO and pay his or her salaries. But are you do you have a working capital requirement and you have a 3-month credit cycle or revenue cycle? कि आपको दिख रहा है कि next 3 months में your revenue will come back, then definitely take if you have chance to get debt, take debt. That's less expensive than equity, right? Because you know that 3 months में पैसा तो आएगा, most likely आएगा, right? Little bit of risk even the banks are willing to take, but that's the nature of the thing. So you have predictability of cash flows is the most important indicator for taking debt. Okay. I'll cover 2 more grants. Don't plan for it, but if you get it, don't squander it, right? So, जो भी पैसा आ रहा है in grants where you're not neither giving equity, neither having a liability to pay, just take the money, right? Of course, there are some nuances like इसको इसी में use करना है, salary इतना percentage होना है, and you can only put it in R&D. Yes, I mean play by those rules. It's anyway free money in some sense, right? Or there might be obligation to report. But ठीक है, get an intern to do it, right? But take the money because this is like free money, no strings attached. Use it and use it for also taking you the next logical orbital. Here is where you can do experiments which you otherwise wouldn't have done because you don't want to take shareholders' money, nor you want to take banks' money and do experiments, right? But you can take grant money maybe to do some experiments like build a new product or go to do a product validation, go to do a new market approach, right? Things like these, right? So select the most attractive project and maybe put it in that. If you have more compelling reasons to use it. But you can always use this money for experiments because that can unlock non-linear value for your company, which you otherwise wouldn't have imagined, right? So forget the thumb, just grab it both hands. There's just a little bit of a joke there, but and sources, all kinds of sources, right? There are also a lot of governments who reimburses your marketing costs, patent costs. So do leverage them. And again, you need some, I can share some lists with you, Abhijit. So do write to me and, we'll take it ahead. Okay, so last thing, this again, not very many of you know, but there are players like Club and GetVantage. They also, it is like between debt and grant, debt and equity, right? Equity may they take ownership, debt may there's a liability to pay, right? Irrespective of you making revenue or not. But some businesses, they will look at revenue-based financing and say, Acha, your business is doing well, I will give you money and I will take a portion of your revenue. So it's a very sweet instrument, right? Because it is hinging on your success. They are also winning with you. It's like an equity, but it is repayment. So it is like debt, right? So it's in between in some sense, right? But it's very nice for a founder because they're betting on your success, right? There are very few people who are betting on your success, right? Like your investors and all of that. A debt holder is mobile. He doesn't care, right? Of course, eventually they'll bet on your success, but they don't care. You don't make revenue, they will still come after you, right? In revenue-based financing, it's linked to it, so they take a little bit of an equity risk, but there's also larger kind of a return you're paying for that risk you're taking. And again, you will only, like the name indicates, you will only get it if you're starting making revenues. And typically there's a lower benchmark. Typically you should make like 1 crore a month and these kind of benchmarks before you can access these sources. But again, happy to put you in touch if you're already in that sector, you're making month-on-month revenues. This is a great way to finance your business. This is also a non-dilutive way of business. It's like equity, but you're not diluting a small percentage also. So it's a good, so cost is higher than debt, lower than equity. Okay. So this is just for completeness. So last I'll touch upon the instruments. I know I am running a little late, but given that you guys were so engaging, I thought, it makes sense to, engage, right? So the one is equity versus preference. So so जैसे मैंने बोला कि early stage it's equity shares. Your founders have equity shares. Many cases, friends and family also, you typically give equity shares. But the moment your traditional investors come, like angels, VCs, PEs, they have something called preference shares, right? Which is CCPS or similar instruments in other countries, where there's a certain preference. Whenever, let's say, you have to pay out money, they will get a preference over the equity shares, right? Then there's convertible versus redeemable. So these are like debt instruments, like convertible notes or redeemable notes, right? your loan is a redeemable instrument. Convertible note or a OCD, CCD are like convertible instruments, right? So those they are like safe notes, for example. There's different iSafe, there's nothing called iSafe legally actually. In India, it is underlying either a CCD instrument or a CCPS instrument. They are the recognized instrument choices in India. There's nothing called iSafe, and even Indian entities can't raise safe notes per se. It is again underlying. It has to be a CCD instrument, a CN instrument, CCPS, or shares, either of these. Okay. Differential voting rights here. I'll not cover this, but there are certain class of shares, preference class, where you can give a differential voting right. For one share, it's not one vote. You can give like 10 shares, one vote, or 1 vote, 10 shares, those elements. This is also sometimes people have used it. Like I said, when you give equity, you're not even giving ownership, you're giving control. Right. So to dilute that control, sometimes you say, I will give you 1 note for 10 shares, right? And things like that. This is all based on negotiation a founder has. I think Ola tried doing this in the past. Elon Musk has done it for his or her investor. So when you have that much of leverage, maybe you can go to an investor and say, hey, I want to take the economic ownership, but not control from me, right? Because as you keep, and this we'll discuss in the next session, where you can give away control as well. And I will cover that. Safe is here. iSafe is a simple thing. Like it's like a similar to a debt instrument, but safe is in mostly in the US jurisdiction. It's a simple agreement with single paper. You don't need to spend a lot of on legal fees, especially in the early days, where you can get the money very quickly, right? And warrants. Warrants are like just options to buy shares. I'll take the question on private placement. This is the way convertible instrument works. They act as a debt on day issued, and they convert to equity whenever next round of funding typically happens. Or sometimes they might also be revenue milestones, etc., where they can convert to equity. They have a definite period, and typically the conversion is at the option of the investor, right? These are all the instruments that are there with which you can raise convertible instruments. You should know these terms. Again, I can't discuss it today. You might need another session for this, but I can show it on the Capita also. You need conversion terms, conversion instrument, whether what instrument out of these, valuation cap, valuation floor, discount from the next round of valuation, and conversion ratio. So these are all different aspects. I know it's getting technical, but I just for completeness, right? So if there are, this might not be relevant to all of you, but let's say if you're looking to raise convertible round, let me know. You can convey it to the organizers. We can do a separate session on this. This might not be relevant for all of you, like I said, right? So that's it. This is the last slide in some sense. So here is where we are going into each stage. So many of you might be in this stage 1 and 2, right? You're creating your value proposition. You're doing your investment outreach. Then you will get a term sheet, hopefully on the day of the pitch or after that, right? And then you go through the whole process. Now I'll talk a little about Capita. So where we help you is in this whole process, we are a tech platform. So we are neither an investor nor are we an incubator or an accelerator. We are an enabler. We are a SaaS platform. We are a product where you can subscribe to us. I'll share that as well. You just have to do a simple sign up, and then you can we give you a software where you can manage your ownership. You can track all your journey, manage your documentation. So, and we also ensure your funding ready. So that is the next slide I wanted to say. One of the offering we are giving to all of the Propel Pitch Fest participants is investment readiness. So you can get a pre-investment check done on Capita. It's a complimentary offering. We give you a free cap table solution. We'll cover cap tables on Monday. You also can manage your data room where all your investor documents can be saved. And we'll also give you a pre-investment check where based on a checklist, like this is a quick checklist of all the documents an investor would ask for. So we'll do a checklist and give you a feedback whether you're funding ready or not, or what are the gaps which you take care of before you go to funding, basically. So we'll do that. And the way you do this, you can scan this QR code. It's a sign up form. I'll also give you the link. So you can just type capita.com/sign up. I think I'm direct messaging it. Yeah, you can sign up on our link. Actually, let me share the actual link. You can sign up on the link, and we will and just mention AIC BMU or just BMU. We'll know that you have come from this program. So we'll give you special benefits for managing all of this on a system, right? And you can also have one-on-one time with us and things like that. Okay, so I'll take a pause. I know there are some questions I can take now. I know that was a little bit of in the end it went technical, but then if there are more questions on those, we can take that offline as well. So I think Krita has asked, even if underlying option is CCPS, iSafe is still a safe legal option. See, yes, So, but then it's not iSafe. iSafe is just a very cosmetic name some of the institutions have given, but ultimately it's CCPS. You have to go into the how CCPS works. It's CCPS is any like any share instrument. It's a preference shares, right? So it will operate in the same way. The convertibility comes because CCPS has something called as conversion ratio, right? So in the future, on the basis of the agreement that you sign, the shareholder agreement, you can change the conversion ratio on the basis of a future valuation. Right? So that's how iSafe typically works, right? Dipendu asked, what is a private placement? So private placement is basically, one of the ways to issue shares as per the regulations in India, right? So you have private placement, you have something called rights issue. A typical company secretary will help you with this. Typically, when you do a private placement, you have to there's a lot of formality. You have to file some forms to ROC, and then you can invite investors to invest in your company. And then there are norms like that. That's where the crowdfunding and private placement there are issues. You can't publicly open private placement to more than 200 people. So there are norms like this, right? And then you also need a valuation certificate from a registered valuer whenever you're doing private placement. So there are a lot of checklists. Depending you need it. If you need more help on this, we can help you. So you can let us know. Speed of execution with CCPS will be so Krita, typically any of these instruments, so safe in US takes just matter of days. It's not even like you don't have to do much of filings and all of that. So you file the safe and you wire the money, you're good to go. In India, unfortunately, there are always filings associated with most of these share-based instruments. So even if you do CCPS, it will be a matter of days. Yes, within days you can do it. You have to call a board meeting, shareholder meeting, and all of that. So your company secretary you need to cover, assume those things. Typically, I've seen it takes maybe at least 2 to 3 weeks to complete all these processes if everything is aligned, right? If your investors are aligned to get the money in the bank, and you also need to give away the share certificates within a prescribed duration, like 30 days or 60 days. So you have to be very careful. Again, we have a checklist of all of this. You can connect to us, right? How to figure out, Nishant asked, how to figure out or filter angel investor, because there are millions of angels. Yes, I mean, you go to LinkedIn, everyone is an angel investor, right? Because even if I put small money in a small startup, I'm an angel investor. So that's why you have angel platforms, right? I think somebody from Jito was here, like, so they are an angel platform. So you can reach out to them, or you can reach out to Mumbai Angels, Indian Angels Network, like that. So the angel platforms exist for that reason, so that they give you a curated window to access those angels. By the way, they also typically pay some membership fee, and also they are curated. They are serious investors. Otherwise, LinkedIn, you can always put out things there, but you need to do the curation yourself, right? Great. I think those were some of the questions. I might have missed some questions, but I'm glad a lot of you had a lot of questions. I think there was more questions on dilution. I think Kritat asked, considering the current market, how do you fix an amount that we want to raise? I'll say, Kritat, my simple benchmark is take money for an 18-month runway at least, right? Uske niche loge to, like, like you will be always in fundraising mode, right? Then that might not be the most optimal use of a founder's time. So I would say go for an 18-month runway and go with that benchmark, somewhere around 10 to 25% based on which stage you're raising funds, right? That's what you might have to dilute. Okay. How to figure pre-money valuation? So again, like I said, first of all, just as a starter, how do you focus on customer revenue? Abhijit, that you have to figure out yourself, right? But that is your business, that you're a founder, right? So if you are not sure of where the revenue comes, you have to go back to your business model and say, what is the value I'm adding to the customer? And then you'll figure out where the revenue comes. If that answer is not clear, I think before raising money, get that answer cleared. Okay. If you want some unbiased feedback on that, I can give you 15 minutes. Tell me your problem later on, and I can see, I can try to help you find that answer. Okay. CCPS does not have a minimum cap. No, CCPS doesn't have any cap. It's just like any private placement rights issue. So even 10 lakh investment can do. Convertible note has a cap of 25 lakhs. So you can't raise money below that. That's why people also use CCDs in some cases, compulsory convertible debentures, right? Yes, you can use CCPS. CCPS is the most common instrument right now used in India. So you better use that. And Mohit, on pre-money valuation, pre-revenue, see, it all comes down to certain benchmarks. Right. So typically an investor comes, like typically it also is decided by the amount of capital you are raising. So investor will try to back calculate ki is capital ke liye I need 15-20% stake. So that's how I calculate my pre-money. That also happens. And there are some broad benchmarks also, right? So an idea stage startup, maybe, if you're raising, let's say $1 million, maybe your valuation will definitely be in the range of 5 million, 6 million, 7 million, that kind of range, right? So, but again, there's no math in the early stage, unfortunately, Mohit. It's market. So I would say the best way to determine the best price is get more than 2 term sheets, get more than 1 term sheet for sure, because then you you are in the market, right? People are putting value to you, right? If you are only going to one investor, you become a price taker. You should either be more like be price maker. So have more options, then price discovery will happen, right? People who really want to invest in you, they will give you a better price. That means they will give you a better valuation. How much weight does investors consider age factor? That's a very good question, very subjective question, Vaibhav. Can't really answer. It does factor in. I have seen investors where, especially very senior founders, like more than 50 years of age, they might look at it in a different angle. Again, that also depends on the kind of problem you're solving, right? If you're solving a very deep-rooted problem, you need the experience, right? So they will go after you. But let's say they feel this problem can be solved by a youngster coming out of college. Maybe they want to bet on that college because they know that, okay, this person will have high energy and they'll hustle. They don't come with a lot of baggage. Again, I'm being very blunt here, right? But that is the reality, right? So investors operate on both spectrum. Can't really answer ki ek answer hai uska, right? But sometimes it's an advantage, sometimes it's a disadvantage, right? No, yeah, Kritan, I won't say that. Typically, in like your Propel pitch mein, right? You're pitching to multiple investors, right? Who's stopping you? It's not like it's like a relationship, right? Then you choose the best. At the post the SHA stage, you shouldn't do much of a shopping, right? Until the term sheet stage, please feel free, right? It's all nobody has engaged, right? In the true sense of relationship, nobody has got engagement. So until the term sheet, just go out there, get as many term sheets as possible so that you have choice, right? After term sheet signature, I think it's not fair to do a lot of window shopping. But then you will also know whether you have been fairly valued, right? Only then you will sign your term sheet in the first place. Great. I think a lot of questions. Happy to answer them. You can also connect with me. I think I had shared my socials earlier, so I'll just share them again. And do sign up on Capita. I think I shared the link. That's the link of Capita, and then I'll also share my question link. So do connect. Glad that I could answer a lot of the questions. If there are more questions, we can take them offline. I will share my email as well. Yeah. I know that took a little longer, Garima and Davinderji, but I hope it was helpful.
No, I think,
Yes.
thank you so much, Srikanth. I mean, what you covered today was not only valuable, but I think because it was so engaging, I think there was a lot of interaction with the people who are there on the webinar. It's been quite some time since such an engaging session on webinar has happened. Post-COVID, people have preferred to be more on physical meetings. But today, what I've seen is that if the content, the speaker, what is being discussed is worth the while, people will still be engaged. So thank you so much, Srikanth. Garima, over to you,
Thank you.
please.
Thank you so much for the insightful session, sir. I would want to take a moment to express our sincere gratitude for the incredible learning experience provided by your masterclass and for taking out the time and effort you put into this session. I would also like to thank all the participants for joining in this session and keeping it interactive and alive. And I can see participants have so many questions to ask. So just note down your questions and ask them in the next masterclass. The next masterclass will be conducted on 10th of April from 4 to 5 on the same Zoom link by Srikanth sir. And also those who have not registered in the Propel Pitch Fest 23 can register it by tomorrow. Link is in the chat box. Make sure to register it and get the chance to grab all the opportunities. And before ending today's session, I would like to thank all our investors, partners, ecosystem partners, participating partners, and supporting partners for making this event happen. Thank you.
Next session is on Monday, so see you all there. You can collect your questions. I can maybe start with a few questions from the session. Yeah, great. I'm glad. Thanks for all the kind words. I know some part of it was technical. If that is required, we'll take it as a smaller session later on. So thanks a lot. Thanks Garima. Thanks Davinderji for the opportunity, and do connect, guys, and do sign up on Capita as well. Thank you.